What are the key metrics to look into while analyzing the companies? How to identify the red flags to look for before investing your hard earned money? And how can we compare different businesses based on the financial performance? Welcome back, friends. Today I'm going to present the financial comparison between two of the biggest brands and trillion market cap companies, Apple and Google. This video have been compiled based on the analysis of the data from financial reports from past 10 years. If you're new to stock analysis, this video will present you with what are the first steps towards analyzing any company and identify the red. This is a list of the world's largest companies by market cap, and today we will be deep diving in Apple, which is ranked first in the list with over 2 trillion market cap, and Google, which is ranked fifth in the list with market cap of $1.17 trillion. Though both Apple and Google are extremely famous and well-liked brands by customers, I was surprised to see the differences in the financial numbers between the two companies. I really enjoyed the analysis and found some interesting facts, which I'll be sharing with you in the coming minutes. So really recommend you to watch the video till the end. To begin with, let's look at the key metrics of between the two businesses. Apple has a market cap of $2.15 trillion and Google has a market cap of $1.17 trillion. But one of the key ratios which I found it to be more interesting is the enterprise value. The reason I look for enterprise value over the market caps because it takes into account the debt a company holds. With an enterprise value of higher than market cap, this means that the company holds more debt than the cash in hands, as in case of Apple. Whereas with an enterprise value of less than market cap, it means that the company holds more cash in hand than the debt, which is definitely attractive, as in the case of Google. So the price to earning ratios of both the companies are very similar, with Apple slightly higher in comparison to Google, whereas there is a whooping difference between the price to book ratio between the two companies. And one of the biggest reasons that why Apple has a higher price to book ratio is the share repurchases it has been doing, which I'll be discussing about in the coming minutes. Top line growth is how the revenues are growing for the company. We would like to invest in healthy growth companies with a good runway ahead to gain healthy returns on the investment. It's important to look into a trend on the growth numbers as well as the absolute value of growth. As the companies grow and become big in size, it's normal to expect the growth slowing down, but as investors, we would still prefer with businesses with healthy growth. The numbers shown here on this chart are the CAGR growth rates for the company. If you're not sure what does CAGR means, please comment below and I would be happy to help you. As you can see in this table and the chart here, that over the past 9 years, Apple has grown considerably well with over 10% CAGR. But in recent years, the revenue growth has been slowing down. Whereas in case of Google, it shows that we can see that it has been growing at a fantastic growth rate in a range of 18 to 20% over the past decade. Bottom line growth is very much dependent on the operating margins. What percentage of the revenues is trickling down to the profit section. As we can see from the graph, operating margins for both companies has been decreasing, coming down from around 35% mark in 2010 to around 22 to 25% in 2020. Ideally, we would like to invest in companies with high revenue growth and consistent or improving profit margins over time. Drop in operating margins indicate that the company have to end up spending more to generate the same level of revenues year on year, or the additional growth in revenue is coming at a very low operating margins in comparison to the previous year. Two of the most common and key indicators ratios for companies' financial strength are the current ratio and the debt to equity. Current ratio shows how much of current assets a company holds over the current liabilities. Low current ratio can be a red flag for the companies in the short term. I personally like to see companies having a current ratio of above 2. Clearly, Google have a fantastic ratio in comparison to Apple. And another important ratio is the debt to equity ratio. Again, Google looks very comfortably placed here with debt to equity ratio of only 0.37 in comparison to Apple's 2.86. My preference in terms of debt to equity ratio is less than 0.5. The reason again for such a high value of debt to equity ratio for Apple is the decrease in equity, which is as an effect of the share repurchases or the buybacks it has been doing recently. Equity in the business is what shareholders own. So business with growing equity is always a preferable sign. All the retained earnings from the businesses help to grow the equity. In case of Apple, the equity growth is negative, which means the equity on the balance sheet is decreasing year on year, and this is happening because of the buybacks done by the management of the company. Buybacks are good for the existing shareholders as the stake in the business grows with it. But investors which are yet to buy the stock should do the due diligence to make sure it's a safe investment. In case of Google, though the equity growth has slowed down in the past decade, but still the equity has been growing at a very healthy rate of between in a range of 13 to 18%. To give you a better idea about the buybacks I have been speaking about, this table presents us with the total cash both businesses have generated over the past decade and also the amount spent by the management on the buybacks. By buybacks, I mean the share repurchases which the management has been doing. Apple have ended up spending over 73% of the total cash generated, which is massive in comparison to 21% that of Google's. An important point to note here is that as 73% of the cash has been paid back to shareholders, there isn't significant percentage of earnings retained to further grow the business. Whereas Google keeps the major portion of the earnings back to business, which helps it to further grow the business. And this also makes sense and now points to the initial part of the video where we saw big differences in the revenue growth between Apple and return on capital employed is an extremely important ratio to understand the performance of the business. Apple have been excellent in maintaining high ROC ratios in the past decade, with always above 20% for the each year and currently safely sitting around 40%. Google also has been performing well with always above 10% and currently around 20% mark. But Apple has been clearly more impressive when it comes to return on capital employed. Free cash flow is the ultimate number which matters the most to an investor, as more the free cash flow a business generates, the better it is for the investors. In case of Apple, free cash flow growth is slowing down, which means that the growth of the company is slowing down, which is ideally not what you want to see in a business. Whereas Google has been performing excellently and growing at a very healthy rates over the past decade. That's all from my side in this comparison. Please do let me know your thoughts in the comment section below. Do like and share if you like it, and also please do let me know if you'd like such kind of analysis videos in future, and don't forget to subscribe to the channel for future videos. Thanks for watching and see you in the next video.